and best advice we can. So we're excited to announce our 2022 theme. Every year we have a theme. Like last year was Hawaii. This year it's going to be Fiesta 2022. So when we have our party next year, it's going to be a Fiesta party. So we may have a mariachi band there. Maybe I'll do a little tocando la guitarra. So just to remind you, whenever we do referrals, we like people, just like you guys. We're happy to help anybody of any age group. Generally, people that are 40 and older are a lot more ready to work with an advisor. We're happy to help younger people, though, not an issue at all. And anytime you send someone to us that speaks with us or meets with us, you get a Security First peso this year. So, we have drawings every quarter for different things for people that have sent referrals. And at the end of the year, anybody that sent a referral will get invited to our client appreciation referral event. So, and you get 2 of them if they become a new client. Hey, Lindsay, could you ask Elaine to push the air override button? I can tell it's already going to get hot in here. A lot of people breathing in the room. I get warm faster because I'm standing here talking.
You got a coat.
I got a coat on too. Yeah. So we gave everyone one of these sheets. So you already have a good idea about the types of things we help people with. So anytime you ever have any questions about that, just let us know. And we look forward to another good year. Now, down to business. Y'all are here because maybe you have some concerns about the economy. Anybody? Okay. And by the way, we also have an online audience tonight too. So that's why she's sitting up here, because my HDMI cable wasn't long enough for her to sit over there. So we're streaming live here. So who has some questions or some concerns that you want me to address during this presentation? Yes, sir.
I've been reading where the Fed might be doing 5 rate increases this year. How's that going to affect the economy?
Absolutely. How will the Fed interest rate rises affect us? Anybody else? Yes, sir.
Inflation of the U.S. compared to the rest of the world.
Okay. How will inflation impact us compared to the rest of the world? Very good question. Yeah. What other things are on your mind with the economy? Anything else? That's the main thing, right? The inflation rate. What else? Anything else? We're going to cover that, and obviously some other topics that I think will be really relevant this year. So let's get started with the presentation. If you'll pull that up. Hey, Doris.
Hey.
There we go. Okay, so investment outlook 2022. Boy, 2021. Every year just goes by faster for me. I learned when I had kids. My daughter's 13 now. The last 13 years have flown by, haven't they? I mean, does time go faster as you age?
Oh, yeah.
It seems like. So we're looking at 2022 now. So that we're going to talk about the outlook. Okay. I'm going past these. So this was our last year's event. We have classes, and also invite your friends to any of our classes. Y'all all got a calendar too for upcoming events. So please feel free to look at those. They're on our website as well. All right. So is anyone amazed that the stock market has gone up 3 years in a row, despite all the craziness? Yeah. Who expected it to go up 3 years in a row? All right.
Good job. Good job.
Well, you called it right, Gary. Well, I'm slightly amazed at the level of returns we've seen, right? 2021 really it was the best year, the 3rd highest return year we've had since 2000. So the year 2000, the market was slightly higher, and in 2019 it was. But last year behind those two was just right behind them. We had a really large returns in equities in 2021. So I'm slightly amazed at how much they have gone up. There's a couple of reasons for it. One of the big drivers of growth last year's federal fiscal stimulus. When you create trillions of dollars, it has to go somewhere, right? You can't park it in the bank. it might surprise you that in the last year, more money has gone into equities than the previous 10 years combined. So that makes prices go up, right? It also makes valuations higher. People have been overpaying for certain stocks. And we're seeing a rotation out of some of those stocks right now, some of the higher growth in tech stocks. So a lot of folks are surprised about how much returns we've had and the fact we've had 3 years in a row. So one reason people were bearish on the market is they thought that the politics would negatively impact the market, especially in 2021. So it shocked a lot of people. I always try to remind everyone that the president's not pulling levers. He's not generating corporate profits. And there's only one thing that makes stocks go up is their profits go up. Over time, if their profits aren't going up, their price is going down. It's just no one's going to invest in a dying company. There was a few companies that filed bankruptcy in 2021 than prior to the pandemic. So we had a super strong year, and it has nothing at all to do with who's in office. It has to do with profits. Corporate profits were super strong in 2021, and the forecast for this year looks pretty strong too. So that's one thing that's a hard lesson to learn is you have to separate politics from the stock market. In a private sector economy, in a free market economy, as long as companies are allowed to generate profits, they're going to do everything they can. Technology, leveraging technology drives profits, efficiencies. The fact that the U.S. is viewed as the world's safe haven for parking assets and cash, all these things have contributed to market growth, and it has nothing to do with the president. And I've used the example in the past. In the late 90s, the stock market was booming, but it had nothing to do with the fact that Clinton was president. We had new technology. We had the internet. We had all these things that the private sector was doing that was making the stock market go up. Bush, he was in office in 01. The market crashed from 01 to 03. It had nothing to do with George Bush being in office. We had a terrorist attack. The dot-com bubble burst, which started in the 90s. So there's a lot of examples throughout history. There is not a direct correlation between the president of the United States and what the stock market does. Now, they can create headwinds, like if they raise the corporate tax rate, that will create a headwind. It definitely will. It won't be beneficial. So I'm not saying that they don't have any impact at all, but they're not steering the whole thing. They're just not. The rhetoric can help or hurt, but it's not going to be what causes the markets to go up at the end of the day. So this is what the financial indicators. These are 20 leading indicators. This is what they look like in January of 2021. We had positive outlook on monetary policy. The economic outlook was good. We had pretty negative look in disposable income. It was neutral. But the only two that were red, the political environment was very heated in January of 2021, and the geopolitical risk was negative. So this was a mixed bag. And the market ended up performing really well. In a few minutes, I'm going to show you what these same indicators look like for 2022. And y'all stop me with any questions. We can make this a conversation. All right, so just looking at performance. In 2021, the U.S. stock market on the whole U.S. stock market returned 25.78%. Dividend-focused investments, which is more in line with what we do, returned 19.47%. A diversified portfolio, in general, is not going to return the same as an index. Does that make sense? The S&P 500 is all U.S. large-cap stocks, mainly driven by 5 tech companies: Facebook, Apple, Amazon, Netflix, Google. Since it's a cap-weighted index, those 5 stocks account for about 80% of the returns, even though there's 505 stocks in the S&P. So a diversified portfolio is always going to lag the market. But what good is diversification, right? It dampens volatility. It helps you reduce risk. So if you're not worried about risk, don't diversify, right? Just buy one stock. If you knew which one to pick, tell me. So we saw really strong returns throughout the year. The top performing sector was energy for 2021, 55% return during that year for the whole U.S. stock market. Technology, 34%, 16 of which came in the fourth quarter of 2021. So if you see the tech sector selling off right now, maybe this indicator is why. Yes, ma'am.
On the energy sector, do you have any information on how that's divided up in terms of like?
The breakdown.
renewable,
Yeah, I mean,
gas.
most of it's going to be the oil and gas sector. Exxon, BP, Chevron, the big oil companies. They kind of saw a recovery in 2021, and the outlook is strong this year. Energy as well. We're slightly overweight, and so far that's paying off as demand for oil increases, and also they're looking at $90 oil prices by summer, so per barrel. So this is the sector breakdown of the S&P. Energy, followed by real estate, information technology, financials were fourth, and goes on down the line. The safer stocks, we call them consumer staples and utilities, they're the core of what we do. Most of my clients are retirees. Now, we do have a growth portfolio, and we're a little more aggressive in those portfolios. But for our income portfolio and for our moderate blue chip dividend portfolio, we generally overweight the safer asset classes. When I say safer, I mean they have high cash flow. They're undervalued as compared to, for example, technology. It's a very overvalued sector. So that's the breakdown of returns. One thing's for sure, it's extremely unlikely we're going to continue on this trajectory of returns. Markets can't return these types of returns every year. Not if the profits aren't growing by the same number. We're seeing people pay more and more per share for stocks. It's called an earnings multiple expansion, where they're paying more per share than they have in the past. So that drives the price up. But over time, we have a reversion to the mean, where people realize, oh my gosh, this is really overpriced. We need to go back down. So there's a saying, the bigger the bubble, the smaller the pin. Right? So the bigger the bubble gets, the smaller the pin it takes to pop that bubble. And we're seeing some bubbles pop right now. Yesterday, Facebook, their shares are down over 20% in one day. Yeah, one day. Yeah, this morning. So and it's simply because they were already really, really overpriced. People were paying what they would pay for tech stocks in the late 90s. I've been warning people, stay away from these unless you're extremely aggressive. I call it speculative. If you're speculative, you really go to Vegas, go ahead and buy you some of those, right? All right. So bonds didn't do as well. Shouldn't be a surprise. First of all, interest rates are near zero. And as they raise interest rates, bond values are going to suffer even more. The outlook for bonds is bad this year, right? So they returned on net negative 1.61 for the year. So we had the negative returns, bonds. Shorter maturity bonds generally do better. Long-term bonds lost 2.84%. Going to global bonds, they lost 10.91%. So bonds aren't likely to fare well moving into a rising interest rate environment. You know how the relationship for interest rates and bonds work, right? As interest rates rise, bond values fall. And it's pretty straightforward. If you've got a bond that's paying a 2% coupon today, and the government raises interest rates and you can buy a bond that pays 3%, the people holding bonds paying 2 say, I want out. They sell those at a loss, and they buy the ones for the 3%. So it puts negative pressure, downward pressure on bonds as interest rates rise. All right, so we've really seen a lot of stocks going up in the last few years. Corporate profits have soared during the pandemic, which is counterintuitive, right? Who would have thought that through a pandemic, corporate profits would increase? Doesn't make a whole lot of sense, but we got to think where the money's coming from, right? It's coming from our government handing out money. It's been the most accommodative monetary policy in history, for sure, like even more than the 2008 financial crisis. Trillions and trillions of dollars were created in so many different programs and asset purchases at the Fed. Just so many things contributed to the corporate profits. Plus, they also ran leaner. I've noticed services have suffered. Services of companies have suffered a lot. They're running with fewer employees, makes their profits go up and their service go down. Right? Inverse relationship to profits. So we've seen extremely high profits over the last couple of years through the pandemic. A lot of people during the start of the pandemic thought we were going to have a liquidity crisis where corporate profits would be so low there'd be no cash on the books to continue. They thought there'd be bankruptcies. And that's when the government stepped in and created a bunch of money, handed out through business loans and programs and PPP loans everything you can imagine, and it never happened. So we never had a liquidity crisis. Stocks went up the whole time during the pandemic. We're about to find out, is there going to be a price to be paid long term, right?
Yep.
So if you sat on the sidelines over the last 10 years and stayed out of equities, you lost out big. That's the truth. The 10-year return in equities is over 12%, 20-year return 7.5%. So, it's hard to time the market though. But really, if you have money in the market, in my opinion, if you're a retiree, you need some kind of a portfolio with downside risk protection, which is what we do. If the market starts to be very tumultuous, like it was in March of 2020, we take, for most investors, if they want this, we take a significant part of their money and move it out of the market to dampen the downside risk. If we see those indicators I showed you, if they all start going red and it becomes abundantly clear that things are going poorly, a lot of our clients don't want to participate in all those downside losses. So our targets are trying to get 70% of the upside of the market with less than 50% of the downside. It's easier to recover if you don't have as much of the losses. The other way to diversify is not put all your money in the stock market. Of course, we have investments where you have some principal protection, where you can draw money out of and not have to be in the market. So we believe in that as well. So for long-term focused investors, having money in the market for most people is a good idea. Inflation's real. The best hedge against inflation throughout history, well, since 1900, have been common stocks. Actually outperformed gold and silver and precious metals. Common stocks have been the #1 hedge against inflation. So if we look at all these different indexes, these are different asset classes, excuse me. This is 2021 going all the way up to 2002. The blue one here is large cap equity. So that's been the best performer in 2021, large cap US equity. But you'll notice there's there's only 3 times since 2002 where that was the #1 asset class. Surprise anybody? So it's not always the #1 performer. Just because you buy the S&P 500 index doesn't mean you're going to beat everybody every year. It's only happened 3 times since 2002. So 2020, the best performing asset class was small cap. There was many times emerging markets were the highest. 2017, 2009, 07, 05, 03. So we believe in diversification. But I do like a core U.S.-based portfolio of U.S. stocks. They are global. Most of the companies you invest in the U.S. that are large cap companies have business operations all around the world. So they do participate in that. But I find it interesting that, different asset classes perform differently each year. That's why I want to diversify. So another good bit of news, there was 6.4 million more jobs at the end of 2021 than they were at the beginning of 2021. So that's significant. We now have a 3.9% unemployment rate. But if we're honest about that unemployment rate, people that have stopped looking for jobs for 6 or more months fall out of that number. So it's really significantly higher than 3.9%. So that was another bright spot. More people are getting back to work. And it says, yes, sir.
How every place you go to say, well, we're having trouble functioning because we're short-staffed.
They
Like
are.
4% unemployment rate, but everybody's short-staffed and can't find employees. It's quite.
Yeah.
It makes sense.
Yeah, it's true. There's a lot of reasons why people are still not going back to work. Middle class, it's estimated they're still sitting on $1 trillion in excess savings from different stimulus payments, so they don't have to go back to work. A lot of people are quitting their jobs, because they're deciding to become one-earner households. But yeah, you're right. There's a lot of people looking for work. I think part of it too has to do with what type of work people do. I don't think a lot of people are equipped for our current economy. They say that a lot of the workforce is not prepared for our services-based economy and that type of thing. But yeah, it's estimated that a lot of women will go back to work this year that have been out the last couple of years. So we'll have to see how that pans out.
Talking about a lot of teachers quitting their jobs too.
Oh yeah,
Wow.
yeah. There's so many
Nurses,
factors,
yeah.
right?
That's
There's
a
nurses
real
quitting their
problem.
jobs. There's teachers. There's airline pilots. There's people that believe in individual sovereignty, that don't want the government's will imposed on them, right or wrong. That's what, and they'll quit their jobs and decide not to work because of that. So yeah, there's still a lot of shortages, especially in skilled labor. A lot of them. All right. So in the fourth quarter of last year, if you look year over year, so fourth quarter of 2021 from the fourth quarter of 2020, 6.9% GDP during 2021. And think about it. It's because during the pandemic, GDP was negative for 2 quarters in a row. So that's a recovery. You know, we've been in a recovery mode, and we're still in expansion. The U.S. economy is still in expansion. Who has a guess as to what the forecast for GDP is this year? The forecasted GDP, gross domestic product. That's all the sales we'll make in the U.S. economy of services and goods, services. It's forecasted to grow at 4% this year, which is really strong. That's the forecast for 2021. You know, for many, many years, the economy grew at 2.3%. Really, the whole 2010s, we didn't see 4% GDP. So we're still seeing a recovery, but we're in an expansionary phase of the recovery. The average expansion lasts 5.3 years. So expansion means after a recession is over, and ours ended in June of 2020. That's when the recession ended. The average expansion after recession, going back 5 decades, is about 5.5 years or so. So it's likely will continue in expansion now, not at the same growth rate, much slower growth moving forward, because a lot of that money, a lot of those profits have gotten back to normal. So we're going to see more normalized growth. We're not going to see 6.9% every year GDP moving forward. That would be amazing. So a lot of people, unfortunately, don't feel like we're in this economy, right? Even just the sentiment I feel talking to clients is negative, right? Because there's a lot of bad things going on in the news, politically especially, you know. So the average American, their sentiment, they call consumer sentiment, it's actually down. You know, it was negative. It went down 13% in 2021. So despite consumer sentiment, stock prices still rose. Money's still flowing in the stock market. A lot of the savings people have had, a lot of it has to do with younger people too. Younger people have began to invest a lot in the stock market through Robinhood apps, you know, and those types of things. You can buy fractional shares of stocks now, so you don't have to have very much money at all to get into the market. You know, we got 340 million Americans, and a lot of people are still plowing money into the stock market. But consumer sentiment is still negative. So I think that'll probably continue. You know, we have a very divided, politically divided country right now, and a lot of people angry on both sides. So that makes us feel like things are bad. But there's a difference between Main Street and Wall Street, right? A lot of differences. They do not match up. You know, the market can go up and everybody can be mad as heck. It doesn't matter. If companies are churning out profits, the stock market's going up. Coronavirus, we still have an issue. At the end of year, on December 31st, the 2-week average, there was 277,000 people. Make sure I get this right. A 7-day average of 277,000 people were contracting coronavirus in the U.S. So that was just December 31st, right? So that's still an ongoing issue. Coronavirus is. Now we hope that most of the devastation is gone from it. But you never know, right? What kind of a new variant may come out. So that's looming too in consumer sentiment, right? We've dealt with some tragedy, and that weighs on people's emotions. So the real story this year is this: inflation. I would say it's the big scary thing this year's inflation. We were up 7% in December. You have to go back to 1982, which was the year I was born, to see a higher inflation there in number. 7%. That was year over year inflation. So we had some questions about inflation. So U.S. inflation is actually lower than that of a lot of the rest of the world. A lot of it has to do with us being the world reserve currency. We export our inflation a lot to countries we buy raw materials from. So countries like Brazil, as an example, their inflation rate, and non-developed countries' inflation rates are much higher than ours. So we have the benefit of exporting some of that inflation. When we import their goods, they suffer more than we do from it. But I am concerned about inflation. It's the number one enemy to your retirement. It really is. Doesn't matter how many dollars you have, they aren't worth anything, right? So I really don't think we're going to have hyperinflation. I mean, look at this. We had 15% inflation in 1980. It means if you had $100,000, it was worth $85,000 the next year. Isn't that terrible?
Oh, that's nothing. I had 11% mortgage in 1981.
Oh,
That's
gosh.
right. That's right. Yeah.
I mean, I'm not, I'm joking, but I did.
Yeah.
Really have-
Oh, I know. I've heard all about it.
I bought some CDs at 15%, 1475
That's
for my
right.
kids' college education.
So inflation, that's going to be one of the main themes this year and how the Federal Reserve will react to it. So they've been pumping up the economy, the Fed has. But we're going to see just how smart they are moving forward, right? What we've done is undertaken an experiment we've never really had. I mean, they did it in 08, and it took them almost 10 years to unwind what they had done. And like I said before, the bigger the bubble, the smaller the pin. So like they're really treading on thin ice here with how they raise these rates. It's estimated they're going to raise them from 4 to 6 times this year. I would be absolutely shocked if they raised them more than 0.75%, more than 75 basis points, because you're going to see a lot of negative pressure on real estate, car loans. Those are two huge markets in the U.S. When rates go up, you can't buy as much house, right? You have to pay more towards the interest. So it's going to put negative pressure on residential houses, car loans. You don't see as many cars moving, that kind of thing. So they're trying to unwind this deal moving forward. So looking at the beginning of 2021, the U.S. Treasury was about 95 basis points. At the end of the year, it was about 1.55%, and today it's 1.83. So if you do the math on that, that's a significant percentage increase. It sounds like a small number, but when you move 30 basis points on 1.5, that's like a 40% increase or some crazy number like that. So moving forward, they're looking at raising rates up to 6 times starting in March. So if you're going to refinance your house, do it now, right? Because as rates go up, you're not going to be able to get as good a rate on it. All right, so let's talk about this year. So remember the indicators I showed you in January of 21? This is where they're at today. We have no red on the screen. These two are red in January of 21. Political environment, geopolitical risk. I would argue this should be red, geopolitical risk. You got Ukraine, Russia crisis. That also is going to draw up energy prices, likely. So we've got a lot of things. Monetary policy still very accommodative. Interest rates are still pretty low. Corporate profit growth is still strong. The average S&P company, their profit forecast fall, 20 to 30% during 2020, 2021. This year, we're looking at more normalized growth, but we're still seeing people meeting or exceeding their projected earnings. And at the end of the day, that's what makes a stock go up. If a company is bringing in more money than they thought they were, people are going to buy more of that stock. They don't care about the other variables, right? If that company's making a profit, they're going to buy. So the outlook is pretty strong for this year. I really don't think we're going to see the same.
Did you point at me? Sorry.
The same type of double-digit growth. Now, this may be a shock to you. This is the 10 to 15-year outlook from some of the world's largest asset managers and researchers. So the highest one is BlackRock. They say over the next 10 years, 10 to 15, BlackRock says U.S. equities will return 6.7%. JP Morgan says 4.1%. This is per year, 4.1% rate of return forecasted for the next 10 years. Morningstar, 1.6. Vanguard says 3.3. So that doesn't sound like too good, does it?
Why so much variation between these?
They're all guessing. I don't know. Not really. I mean, it's too hard to see 10 years out in the future, but they look at valuations, right? People are paying, for certain sectors of the economy, 40 times earnings, where in reality they should be paying 25 times earnings. So if you factor in that, how prices are going to come back down and match up with the profits coming in, prices have to come down because people aren't going to forever overpay for equities, especially as interest rates rise. You know, you got the risk-free rate. Like if the treasury yield was 5%, a lot of people would rather take the risk-free rate of 5% than invest in stocks. So as rates rise, that's going to put negative pressure on equities. Like back in the day, you could get decent bonds paying, 5%. That's unheard of now. You got to go back 2008, 2007 to find a decent bond paying 5%. You got to buy the junkiest of junk bonds to pay 5% a day. So rising interest rates, higher valuations, those things put negative pressure on equities. Bonds, they're actually likely to perform slightly worse than equities, but still not as big of a difference. 4.1 for equities, 2.8 for bonds. You can see like someone super conservative, if they knew they were only going to get 4.1 with a lot of risk, they might choose 2.8 with less risk, So, but for this year, most analysts think 5 to 7% for U.S. equities, and that's kind of what I'm thinking for this year. And unless they mismanage the interest rates going up, if they don't pay real close attention, I'm sure they're trying not to blow it all up. But who knows what's hiding on these banks' balance sheets, right? They didn't know in 2008 when we had a financial crisis that there was $100 billion worth of bad loans, and Bear Stearns had all these derivatives hidden and all this stuff. So, as they raise interest rates, that's going to expose companies that have mismanaged their capital. And so that's a possibility too, that as they raise interest rates, it's going to show how some unhealthy companies aren't going to survive. Companies depending on low interest rates, So I think that's something we were watching for. And that's the main theme of the year is watching the Federal Reserve, inflation, interest rates rising. How's that going to affect the overall market? That's something we're watching closely. For the rest of the world, China's in really bad economic shape. Most people are advising not to invest in China, which we don't. I like to invest in companies I can trust their balance sheets, right? That have GAAP accounting principles, generally accepted accounting principles, and have some kind of regulation, making sure they're not lying, right? They'll say this year they have 12% GDP and they're negative 10. They really have been caught doing that, lying about their GDP, lying about other things. So China is not a place to invest your money this year. But outside of China, developed equities should do pretty well. They should do pretty well. They're undervalued compared to U.S. stocks. Now, I don't generally invest in those very heavily because I still like to buy undervalued U.S. blue chip stocks for the core of what we do. They're very reliable in the way they can recover when you buy them undervalued. A lot of the stocks we buy when they're beat up, they have a history of recovering and paying a nice dividend while you're waiting for them to recover. So some of the trends we're seeing right now, we are seeing a de-risking happening because everyone's seeing this tech sector especially is overpriced. PayPal's getting hammered. Facebook's getting hammered. Now Google, on the other hand, Google just did a huge stock split, and then they jumped way up in price. So some of the trends we're seeing, though, is a rotation out of the growth sector into the value sector of the market, which shouldn't surprise people considering, the valuations on tech stocks are really rich, and you can get a much better deal buying value stocks. A lot of the value stocks are sitting on tons of cash, very, very rich, good, solid balance sheets. And that's what you want. You want a company, in my mind, for somebody that's a retiree that's relatively conservative, you want cash cows. You want companies that are sitting on cash, that can weather the storm, right? That don't have to refinance their debt, aren't going to be in all this kind of trouble. And that's the core of what we do. That's the big trend, is the rotation out. The other trend is inflation. It's here to stay. It's not going away in the next 2 or 3 quarters. This was out in the city of Los Angeles, been $6 a gallon out there recently. Of course, half of that's tax. They love the taxes out there for California. So inflation is a theme that will continue throughout the year, and that's really why they're having to. They don't want to raise interest rates right now, but they're forced to because too many people are suffering, buying higher and higher priced food, and energy costs are going up. So working class Americans do not want to pay this much more for goods and services. So the only option the government has at a bad time in their mind is to raise rates in the very beginning of recovery. So it's a delicate balance. It really is. So I believe you want to be invested in the strongest companies through this type of market. So let's hope they've learned some lessons. But we're talking about the government here. So I don't know if we can count on them managing the economy. It's always blown my mind how you get a group of, even if it's 50 really smart people, there's no way they have the information that the whole economy has. How do you know all the variables? How can you pull a lever over here and make this go up? I don't get that kind of philosophy, but that's what we have with the central bank. The central bank thinks they can take in these macroeconomic data points and pull some levers over here and raise interest rates here and hand out some cash over there and prop everything up. We'll see how it works, right? But instead of just counting on that, I believe in having good, strong diversification. So COVID is something they're still watching. I don't think we're completely out of the woods on the monetary policy front or the COVID front, but it does seem to be improving. The picture seems to be improving. Globally, there's a pushback against restrictive government actions. I mean, in Canada right now, they're having a constitutional crisis. They're about to convene they're suing the federal government for not letting people cross the border, those kind of things. And they can't travel amongst their provinces in Canada either. So there's a lot of political things, and that hurts businesses. So that's something, obviously, we're keeping an eye on. And here's something I was going to touch on. Diversification sometimes can feel disappointing. Now, for most of you guys, you're happy with a reasonable rate of return. But there are folks that want to get 100% of the upside of the market and 0% of the downside, right? Who doesn't want that? Yeah, who doesn't want that? But in reality, diversification in good times, you will underperform the market. That's just what it does, because not everything blooms at the same time. If we knew exactly what to buy every year, we go back to that chart and say, all right, this year on 100% emerging market equities, next year I want 100% small cap stocks. If we knew exactly what was going to be the top performer, we diversify that way. But just looking here, the S&P 500 from 2000 to 2002 returned negative 40%, negative 40. A diversified portfolio returns negative 17%. So diversification helps there. From 2003 to 2007, S&P returned 82%. Diversified portfolio returned 80%. Still pretty good. But overall, the total return of a diversified portfolio from 2000 to 2021, 275% total return versus the S&P of 268. So over the long term, diversification helps you. It really does. So that's why we believe in having asset class diversification. Have some money that's safe and protected from market losses for most people is wise, because then you can pull money from there when you need income. Then having a portfolio where you have downside risk protection, where we're gonna hold on to our blue chip core stocks, but we'll take 30 to 50% and move it out of the market if things really get bad. So
What do you mean by total return?
total returns, you add up all the returns over the whole time. Yeah, that's right. So right now, a lot of the U.S. stocks are overheated, but we still think the U.S. is a good place to invest. I like to invest in companies that I can understand, that we know what their business model is, and we have a very long earnings history. So 25 years or more of dividend history is what you have to be in our portfolio. You have to have paid a dividend for at least 25 years. You have to have earnings increases 7 out of the last 12 years. You have to be A- rated or higher with S&P. You have to meet all these criteria to even be considered. It's a big part of our blue chip core portfolio. And those are all U.S.-based companies. There's plenty of money to be made in the U.S. I don't really think we have to get exotic, go into emerging markets. There's too many unknown variables for most of our clients to go there. And this is the big thing too. Avoid the urge to time the market. I mean, I had people in 2020 tell me, I want to get out. I don't want to get in at all. And they've missed out on so much returns. And inflation is a bigger risk than the market to me. We don't control inflation, but we can manage risk in the stock market. We got no control over the cost of the goods in the U.S. We don't have any control of the printing press, right, or anything. But we can manage risk in a portfolio. So this is what everyone wants. And this is what you'll get when we'll hold your hand. All right. Any other questions before we wrap up? Did I answer those?
Could you speak to the state of the automobile industry?
Yeah, I mean, there's still shortages, big time shortages because of microchips. They're starting their own now. So 90% of microchips are made in Taiwan. 90% on the planet are made in that one country. So now you're seeing automobile makers like Ford, Chevrolet spinning off different arms to make their own microchips. They're still very profitable. I mean, the big auto companies, they did take a hit, of course, during the pandemic, but a lot of their stock prices have recovered pretty consistently. You're not going to see as many new car sales if they can't finance at 0% for 7 years. You know, that's what people are doing. They're rolling negative equity out of one car into a new one, rolling it into a new note. That's all going to stop. When interest rates go up, lenders aren't going to be willing to do that. So there's going to be a downward pressure on the car industry, especially, you know, trying to sell new cars that are, you know, those new Tahoes are like $100,000. Have y'all seen them? Like the baseline model, it's like $100,000.
We have a question online, Daniel. How will this affect our taxes?
Well, our taxes this year aren't going up. They've already messed up. They can't raise them. They're not going to raise them in the middle of the year. I think they're going to try to raise them at the end of this year for sure. It's yet to be determined. To be determined on the taxes for next year. Mike?
As far as those Taiwan making the chips, okay, is China controlling Taiwan as far as the chips and the distribution of chips is going?
I mean, they certainly exert a lot of influence over Taiwan. That's why it's shocking to me that U.S. companies would be willing to risk that. You know, we got all these. That's another issue. You know, the supply chain crisis is still going on right now.
At the lowest price.
Yeah, that's the thing about exporting everything out of the country. Now we're seeing the real risks of that. I'm hopeful that we start bringing more and more manufacturing back to the U.S. because it is a risk. It's a risk when you have supply chain problems and you can't import stuff. I got a client. He was paying $5,000 to ship his good merchandise from China to the U.S. and he just paid $50,000 to air freight it. The same thing.
Wow.
Profit margin.
Now imagine what makes, that's another reason prices are going up. It's not just the money printing, it's the supply chain crisis. All that makes prices go up as well. That's still an issue. You know, a lot of those things are kind of ironing themselves out. And hopefully by summer, most of the supply chain issues will be taken care of. But I think inflation's here throughout the year. Any other questions?
What about the U.S. debt right now? I mean, it's getting
The debt? Yeah.
$30 trillion.
30 trillion.
I mean, how's that impacting?
Well, as long as we can continue, as long as we have the ability to monetize our debt, right? So here's what happens every Monday morning. They have a treasury auction, right? So instead of raising taxes, which is what any sane country would do, if they have bills, they raise their taxes, and then all the people are like, yeah, raising my taxes, get out of office. In our country, neither party is accountable at all because they can go to the Federal Reserve, and if they're not able to sell enough bonds on the treasury auctions, the Federal Reserve will buy the bonds. So I believe it was a couple years ago, the Fed bought 70% of all treasury bonds. No other country can do that, just the U.S. So like if they didn't have a buyer, right, if individuals, and most holders of U.S. debt are citizens of the country, if there's not enough buyers of treasuries, they have to go up interest rates, right? If nobody's a taker at 1% or 2%, they're going to sell the treasury bonds at 3%. But the only way they can keep them low is the Fed says, oh, no, we're not going to let that happen. We'll take $40 billion of them. And they'll just buy them and put them on their balance sheet and suppress the interest rates. So that's how they're managing the $30 trillion.
Yeah, one time I heard most of our loans were coming from China. You know, we were borrowing money from China.
Some 15 to 20% of our debt is owned by China and Japan.
Is that all? I thought it was higher.
No, it's not. That's not. I just looked recently. Yeah, I thought so too, but it's not. Most of them are on. Think about the government, the G fund out on base. Those are all treasury bonds. That's where all their bonds are bought. Yeah, but a lot of bonds are owned in ETFs and mutual funds. And, you know, a lot of buyers of U.S. debt, even at these low rates. It's crazy, right? Yeah. But yeah, I think it's a long-term problem. I really do. at some, like if interest rates went to 5%, the number one payment on our like if you look at number one expense right now is military spending. Within 10 years, it would be servicing the debt will be a bigger expense than military spending. Just going to 5% interest rates. So,
What's going on with Bitcoin? I keep seeing that on TV. But
yeah. Well, the government's getting involved. They've regulated it. So usually when the government regulates something, it's here to stay, right? If they were going to deem it illegal, which surprised me they didn't, because it's a competing currency, and we know the government don't like competition. Because you got another currency, Bitcoin. Now there's dozens. But when they regulate something, usually they've legitimized it, right? They're not going to regulate something and then deem it illegal after they've already regulated it. Of course they could, but it's not likely. They manipulate the market too. One of the bigger holders of Bitcoin is the CIA. And the CIA owns a lot of Bitcoins. They really do. Yeah, so they can manipulate the market on that. But I think it's here to stay. Bitcoin's the biggest market for it. The rest of them are kind of fads, like Dogecoin, the one Elon Musk. He tweeted the other day, he said, "I'll buy a Big Mac when I can buy it with a Dogecoin." Then that went up like 10% the next minute, just from his tweet. But yeah, Bitcoin is here to stay. It's still there's no price to it. Like there's no reason. There's not a supply and demand. You can't accurately price it. It's just about adoption across the economy. I don't know. I think it's decades before it's a stable asset. El Salvador really screwed up when they made it their country's world reserve currency. That's right. They made Bitcoin, and then it dropped in half. So now they got a crisis. All right. Any other questions before we wrap up?
Worldwide inflation, where are we at compared to major countries?
Well, our inflation rate, as my understanding, is we're lower than the Western Europe. Like I said, we are the world reserve currency. We can monetize our debt differently. So we have a better footing in inflation than most other countries. I do have a chart I can show you on that, country by country, what their inflation rate is. Yeah, I think France is one of the worst. Brazil, South America's always got high inflation. Yeah. What is
Turkey.
Turkey's probably worse. Probably is.
Greece.
The big countries, Portugal, Italy, Greece, Spain. Yeah. All right. Anything else?
Oh, just I've been watching the ag reports, and it's kind of looking good for the U.S. because South America, their grains are underperforming.
Mm-hmm.
Russia is underperforming in their wheat.
Yeah.
Their
food prices.
And there's a lot of issues with supply chain.
Yes.
Moving product around.
Yeah. The food supply is an issue for sure. I read that because of disease and the cold temperatures in Florida, the cost of orange juice is going to be like double what it was last year. All right. Well, thanks everybody for coming. We appreciate you being here, and we've got food for everyone. And I'll be here to talk to you if you have any other questions. We look forward to a good year. Thank y'all.
Thank you.
Everyone's welcome to stay and eat, but if you want to pick up your food, you can pick it up too.